Hey guys, what's going on? I hope you're doing well. Now, in this video, I want to just talk about a more specific and more actionable way that you can use market structure as your directional bias, because I know that I've mentioned it in the course, but I feel that you will probably need a little bit more of a thorough explanation, because the way that I read market structure with this specific approach is a little different to how a lot of other people use it. And I'm going to start off really, really simple with just a simple 1-2 time frame way of using it, followed by a higher time frame way of using it where we're encompassing multiple time frames. Okay, so basically the thing to understand with market structure, as everyone knows, in an uptrend we have higher highs, higher lows create higher lows create higher highs. And if this sort of pattern happens here, where we start coming up here, at this point in time, this is not a higher low. Why? Because it hasn't made a higher high. Now, when most people look at a charts, they'll be zoomed out about, this much. They'll be looking, they'll be like, right, this is going up and it's retracing. Okay. The market structure that I'm going to be talking to you about today is recent price, okay? Meaning it is each individual price swing. It is getting hyper technical into exactly what we're looking for and why, and it's using that to determine the overall direction that we are looking for. Okay, now just to give you an example, this would be my high low. If we draw it from the bodies, it's probably cleaner. This would, oh, in fact, no, it wouldn't. That's my bad. But let me just explain it this way first, okay? In an uptrend, okay, the first sign that we have, or the first sign that we're going to be paying attention to in this example is, or that the trend is going to change direction, is when this last higher low breaks. That higher low must have made a higher high. Okay, so very, very simple. When we see that that breaks and then confidently retest, then we can begin to change our bias. Now, when we do this on a higher time frame, it's going to give us a very, very simple way to be like, right, it's in this direction, it's in this direction, etc., etc., etc. Now, you don't have to use this tool, but it is helpful. And if you did draw the fib once you've identified your range, because this is your range, the last higher low to the last higher high, then you can identify where you are in that range. And then you can cut down your time frame and you can then begin to look for a shift. And what is that shift going to start off with? It's going to start off with our supply and demand zones. So if we were to zoom in to what we're seeing here, let me just draw this out. Okay. We come up, we come down. And as we come up like this and we come back down, on the lower time frames, we're going to have, lower time frame structure, little ranges like this. And then, if we see something like this, okay, we've seen structure break. Let me just draw this on so it's complete. Okay. This right here, what does that fit our rules as? That is a very, very nice drop base rally zone. Okay. And that was the rally there. We return. This would have been the perfect trade setup. And then we look to take it. Now, this is a very simple way of doing it. And let's say that this over here was on the 1 hour chart. So we've got that just like there. And then here we've got the 1 minute chart, for example, a combination I'm a big fan of, although the 1 minute can kind of lead you astray sometimes, but sometimes the 5 minutes easier. Personally, I'm used to reading the 1 minute, so I don't mind doing it if I'm going to do this approach. Okay. Now, it's very, very basic. You use one time frame for your higher time frame. You can also mark on your phases and stuff like that on that one time frame, because this is a 2 time frame method. Remember, I said I'm going to start it off simple and then move up. But then when you move down a time frame, you're looking for those ranges, this, the price range to shift in our direction. And that shift in a price range, in this case, this bullish push up, breaking past all of these structural highs. Okay, specifically the last one is the one we're focusing on. What we are doing is displacement. Okay, and I talk about displacement in the course. It's essentially just a shift in how things are going. And so when price returns there, this becomes our demand zone, which becomes a very, very high probability setup. Okay, and so we would have something like this, stops below the zone, and then depending on your target, old highs, whatever your particular style is. Okay, but remember, this particular method is, especially, it works with block to block and trend following setups, but because this is a clear trend, targeting the old highs would be completely fair enough. Or if you're a bit more conservative, you just want to be in and out for the day, something like that is absolutely fine. Okay. And it's very, very simple. Now, before I show you some examples, I just want to compare this to combining multiple timeframes. And by multiple timeframes, I mean stringing together 3, maybe 4 of these timeframes. For example, you could start on the daily and map out the range there. Then you could go to the 4-hour, map out the range there. And then you can go to the 1-hour, map out the range there. And if you really want, go down to the 15-minute and map out the range. Okay. Now, one thing to understand is if we are going up like this, okay, and this is our range at this current point, okay, from that last higher low to the last higher high. One of the most fundamental aspects in trading, investment, all of that stuff is the idea of buying low and selling high. Okay, now if we are near the top of a range, meaning we're near to the point we've just made a higher high in, or if this was a downtrend, we're near the point where we've just made a lower low in. That's not going to be the most ideal place for us to look for buys in this example. That is why the fib is a good visualization tool, because you see it, you're clearly waiting it for it to reach into these levels. And the reason they work is because they normally coincide with supply and demand levels. Okay. But that means that if we are on the daily and we see this structure here, does it mean that we can't take any sells whatsoever? Well, no, because that's the daily time frame. If we then cut down to the 4-hour, we could see a range like this, a bearish range, because we've made a lower low. Okay. And then in this case, we could potentially look for sells. But where would we look for sells down to? Because remember, this is slightly more risky. Okay. And again, I wouldn't recommend this if you are new. I'd just stick to the trend following methods. However, the reason that I'm showing you this is just so that you can understand and internalize what I'm trying to say. Okay. So if this is a bearish 4-hour range, meaning on the 4-hour, we've made a lower low. Obviously, it doesn't look like a lower low here, but on the lower time frames, it probably would. We can sell, in this case, we can trade the retrace, in other words, down to the 50% level. Because if you imagine, trading and buying price and selling price as if you're at the supermarket and a price has a 50% or more discount, that's a really, really good deal. Okay. And most people would jump on that. And it's the same thing with trading. As soon as it comes below this 50% level, you are more than likely to experience a lot more resistance in the form of, that trend increasing, because people will be increasingly buying on the retrace and stuff like that. Okay. So it means that you could sell hypothetically down to the 50%. But just to keep things simple, as soon as it goes below that 50% level, we are buy bias on our main time frame. Okay. And what you're going to notice is, if you do map out all of these time frames here, let's just redo this. So if the daily in this case is bullish, okay, you might go down to the 4-hour and it's bearish. Okay. So it's like, well, okay, well, you only take note of this up to the 50% of time frame above. Okay. Let's make that a bit easier, of range of the high time frame. Okay. So as I've just shown you here, we are, we would be in this bearish range here. We break out on the lower time frame. It's a downtrend. Okay. But we are aware that overall we are above the 50, and that is why we can begin to trade it. Now, this is very, very risky. It's not even that risky, but it's just confusing if you're just starting out. I remember when I first was kind of molding this concept together, at least this is the way that I internalized it. It was very difficult for me to piece these things together. And so I'm going to give you a simple way to get over that in just a second. Okay. So you're bearish up to the 50%. Maybe you go to the 1-hour, and more than likely in this scenario, you're still going to be bearish. Okay. Again, it's the same principles that apply. Okay. What the higher time frame is doing, it's just giving you the perspective of where you are in the market. So it's like, right, okay, overall we're bullish. And especially when we come below the 50%, then we are, especially monitoring for only by, sorry, excuse me. Then we're monitoring for exclusively for buys. Okay. So the 1-hour is bearish in this case, again, up to the 50% overall range. Okay. And long story short, when we get below the 50%, what we're looking for is we're looking for our lower time frame. Okay. We're looking for the range to shift in our direction, meaning, as we mentioned back here, this would be the range shifting, because if we zoom into this like this, our most recent range would be here, this lower high right here. Let's just make that abundantly clear. This lower high to this lower low down here. Okay. Okay, and so when that breaks, that is a bullish sign for us. Okay, now in the exact same way, if we can find where we were, when we're in an overall, in this case, daily bullish range, and we start to see the 15-minute, in fact, for this example, the 30-minute would probably be better, and we start to see 30-minute structure shifting in our direction, okay? That structure shifting is the sign that the higher time frame, overall direction, may be beginning to come into action. Now, of course, this might not always be right first time, but overall, chances are, over a large enough amount of trades, the majority of them are going to be, in your favor. Okay, and so the 30-minute, you would simply look for a structural shift. Okay, now this structural shift will coincide with a demand or supply zone. Okay, why? Because something has caused that structural shift. Okay, and it is an influx of orders. Okay, supply and demand works off the concept of buying low, selling high, orders coming into the market. And so when price returns, that is what gives us our edge in the market. Okay, and so just as I showed you down here, this zone, this previous range, as we break out, we come back and this is a demand zone. Okay, not the range, just the standard way that you would pick a demand zone, because we see a nice strong move down, we see a base, we see a decent move out. If it did come back here, for example, for a second, touch or whatever it was, just to give you, an example. Okay, now if this one confused you right now, don't worry. I'm going to just explain to you or show you examples of using 2 timeframes first of all, okay? Because it's better just to master these 2 timeframes, or not these specific 2, but just 2 timeframes, can be any 2, before, trying to get more advanced with this concept. Because, I mean, if you just mastered this concept, you'll be in a very, very good position. Okay. And so in order to get this concept to work, we need to first identify how to read recent price. How do we read price on the charts in a recent manner? Okay. Now, sometimes the line chart can be easier to do this. It depends. But essentially, just to give you an idea of what I'm looking at here, when we're reading recent price, this is a downtrend. This is a downtrend. And I'll explain why I'm drawing them like this in a minute. This is an uptrend. Okay, we gone lower there. We have, but we haven't made another one. No. Okay. This would be a downtrend there. That would also be a down move there. This would currently be an up move here. This is not, we're not using trend lines especially here, but this is just to give you an idea of how recent I'm talking. I'm not talking about zooming out like this and going, okay, well, we've had a big push up here and like, great, like we're at the 50, like let's buy, like, no. Okay. The reason recent price is so important is because it keeps us very close to momentum changing in the market. And so ultimately, if there is a 4-hour level right here, okay, regardless of whether we've got that marked on our chart or not, I can see at this point pretty much that things are beginning to shift. In fact, not this point, probably this would be my last high low. Okay, so just to give you an idea, I'm just going to mark on higher lows and lower highs, because those are the things that are going to be determining our bias, meaning as long as we stay above the higher low, okay, and there hasn't been another higher low, valid higher low that's formed, meaning another higher low that's created a higher high, then we're going to remain bullish. Okay, unless there's new structure that forms. Okay, so we can see that we come up here, create this wick up here. Yeah, we stop around. The reason that earlier I was thinking about putting this as a level was because when we come up, we come down, and then we come higher. That would be a valid setup for us. Now, the reason that I didn't was because this wick up here is higher than this wick up here. And even if price wicks just a little bit above, with this particular method, that counts as a high high or a lower low, a high high in this case. But we can see that this wick didn't do that, okay? But the reason that I was considering doing it is because the close was higher and because it's just a little bit higher than that retrace. Don't worry about the technicals of what I just said at all. Just think about it like this, okay? If we were to draw it on the line chart, we can see that arguably we come up here, create this higher high, this higher low, and then we have this small higher high here, okay? That is the only reason I was confused. We see that we do then break down, we respect it, and then we come down, okay? Now, at this point in time, this would be our last lower high, meaning as long as we are below this, we are going to be sell biased. Does that mean it's always going to sell off? No. Okay, of course not. Okay, but again, this is going to come down to your time frames. Now, sometimes, whichever time frame you pick, really, on the lower time frames, let me just restart that. If you pick the higher time frames as your directional bias levels, you're going to get less setups, obviously, but you're going to get less contradictory information, meaning we can see that here we've had the last higher low. Let's pretend we didn't even see this. This is our last higher low, meaning until we form new structure or we have this here, we are going to be by bias. Okay, now when we get down here and we see that we've made lower lows, lower highs, and then we break that to the upside, that's a great, nice signal overall. But then we could get confused in this noise about, right, okay, at what point do I change my bias? Because a lot can change in this time period. Just because we've got this level marked on doesn't always mean that our overall bias is going to remain. Okay, and so this is going to come from practice of drawing in these key levels and whatnot. Okay, and so let's just stick to the current price swings. We see price shift up here. Okay, we could also have this as our last high low at this point because price came up, it came down, wick down here, and off this wick it pushed up and made this high in the form of this wick. Okay, we then break past that, indicating bearish pressure. And I know that you might be looking at this going, oh yeah, but look, obviously this was going up and blah, 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 blah. But again, this is just to illustrate to you how it's possible to draw recent price. And, this is going to be especially helpful for you when you do go to those higher time frames. Okay. Again, you're welcome to draw it from the bodies if you would like. Just be aware of, fake outs a little bit more if you choose to do that. It's probably a little bit clearer in this example. We see here, until we break this confidently, we are going to change bias. We can see we do close above it, but I wouldn't really consider that a very confident break. We then flush downwards. Okay. As soon as we flush downwards like this, what are we looking for? The last lower high. Where would that be? Well, it would be from the top of this wick up here. Again, bodies, wicks, it's up to you. So it could be there or it could be there. Okay. But we're doing it from this kind of lower high here. We then come back up into our range up here. That would have been a nice short. We'll go and look at that in another time frame in a minute. So this is our current low at this point. At this point, we came down to this low, then we started retracing. The next low that we've made was just here, okay? So this would be our last lower high. Why? Because we made a slight lower low down here. We can see it's slightly lower than over here, okay? So we retrace, we wick above, we begin coming down, okay? Now at this point, again, we have this as our last lower high. And as you get more advanced, you can use this as your last lower high because of what that market structure tells you. But don't worry about that too much. Just think about it like this. For now, we see a decent break above. This becomes our last higher low at this point. But then we make this higher high. We come back down in this wick down to here after this candle opens, and then we push off and make another higher high. Therefore, this becomes our last higher low. Okay. Hopefully you see how I'm just being very close to price. And, if you find this difficult to see, just go to the line chart. If you just want to use the bodies, that's fantastic. That's no problem at all. Yeah, you can very clearly see these market structure shifts. And if that's easier for you, then by all means, go ahead. Okay. So now that we've got these levels marked on, and in this case, obviously, we're using the 1 hour as a high time frame. Let's just cut down to our 1 minute and look at how we would have organized this information. Okay. Okay, so starting from here, we can see right here, if we draw our fib out just like this, what do we see? We can see the price comes back up. Okay, now at this point, you're more than welcome to draw on existing areas where price is likely to respond. Okay, you're welcome to do this on the 5 minute as well, maybe even the 1 hour, to be totally honest with you. But we know that it wasn't that clear from when we were on the higher time frame. Okay, but on the 15 minute, for example, you can see that there is a kind of drop base rally type zone. But if we were to go down the lower time frames, this is going to look like a much better quality zone. Okay, and you're going to find that quite often. Okay, so if we just go back to the 1 minute, we know we've done a bit of a circle there in terms of time frames. But here we see we've got a decent up move here. We then have a very strong down move, and that's lovely. Okay, so for something like that, we could have this rough zone marked on here. Okay, now what are we looking for? On the lower time frame, we're looking for the structure to shift in our direction and therefore creating a very strong high probability zone for us. Okay, so if we were to zoom in here, Where's our last high low that made this high at this point? Well, it would probably be here for me. Okay, we can see we create like loads of different pieces of structure within here. And then up here, what happens? This would now become our new high low. Okay, because this high low created a high higher than this previous high. We break downwards, we come up, we have a bearish rejection candle. And where do we reject in out of all of this area? Well, we reject in this supply zone right here. Okay, specifically about 50% of the body candle because of the size of these candles. That is the other way that we can do it. Okay, now let's just say you missed this. Okay, let's just say you missed it, you tried your best, didn't really work. Okay, extend it out, you never know, price may return again. Okay, we can see here again, even if you didn't have this line drawn in, you would have had another opportunity here. Very nice move up, decent move down, not the best move down, but because we've got this higher time frame context, then we're okay. Enter off the bullish engulfing, stops above that level, and then whatever your target be, you know, whether you want to be a bit of a can't think of the word, bit of a gangster and go to the lows, that's absolutely fine. Again, that's a different video. That's about, you know, deciding your trading plan and your risk management, etc., etc., etc. But all we've done is we've just waited for the momentum to shift in our direction, and we just looked for the same setup again. Very, very easy. Okay, if we were to look at this example down here, that's not especially clear. Let's just look here, for example. So we draw it from this line. Oh, I didn't mean to do that. Okay, sorry. To draw it from this line up here, all the way up here. Okay, so as soon as we get below that 50%, we can begin to look for things to shift, even if you just saw this shift initially. Okay, you see this last lower high here, you see it violated to the upside, and then you're simply waiting for a return into this area here. Why have I drawn it from here? From this point right here, that wick, to this wick up here, because that's all part of the same consolidation, accumulation, whatever you want to call it. And then simply, you know, if you wanted to, you could enter on something like this. Now, this may not have been the best trade. 1-to-1 would have hit targets. Anything else wouldn't have done. So if you had a 1-to-1 break even, you would have been fine. But again, it's not about being right here. It's about being systematic. Okay. Now, even if this did, let's say you didn't even go break even, it just stopped you out. Okay. No problem. We're only at the 50%. And if you just want to prioritize 618 and below, I'd probably advise that, if I'm being honest. Okay. So if we come back down here, okay, and we're waiting for structure to shift. Okay. Has it shifted at this point? Would we be looking for buys here? No. Why not? Because on the 1 minute here, we are still in a bearish range because this is the last lower high that created this lower low. And so we're still in a bearish range. Okay. Just to make that range abundantly clear, that would be down here. Okay. So from this lower low to this this lower high to this lower low, we then retrace and then we break out to the downside, and then we can begin looking for a shift again. Okay. So where would be the last lower high? It would be here, wouldn't it? Because this, we came down into this level. If we look at this on the line chart, you see we came down into this level, created this lower low, came up, created this lower high, came down, created this lower low, confirming this lower high. We break up above, and then we start rejecting it in a very, very nice way. Okay, and we can see here, this is where we would draw our zone. It's not just from this candle here. I also include this because often you're going to find in moves like these, the price comes down, and as it makes that initial move up, it will stall a little bit more, which is what this is right here. It will come up and it will either touch this first area here or just down here. So I find that by drawing both in, it's really, really nice and simple for you to be able to, you know, decide on your entry. And so, you know, in this case, you know, the entry may have been a little bit late, maybe something like that. You know, stops below the zone being traded. And so you could argue that this is the zone being traded in this case. And then, you know, look to, you know, whatever your targets are. Again, that's a topic for another video entirely. Okay. But what you're doing is you're capitalizing on these small little pieces of the market rather than trying to guess the whole, you know, thing and trying to like predict these huge swings and whatnot. Okay. So it's very, very simple. You know, if you were to use the daily, It's the same process again. Okay, you can use the weekly, whatever time frame you want to use. Okay, so you could start on the daily, for example. You could mark this as your daily range. You could draw the fib out just there. Doesn't need to be anything special. Then you cut down to the 4 hour. Okay, now that we're at this high, we are definitely above. Oh no, we've just touched the 50%. Okay, but if we were to go down to 1 hour, just to make this clear. Okay, so this is our 50%. Okay, so if we just extend this 50% out like this, and we are on the 1 hour time frame like this, we can see here that we've created from this lower high, which is lower than this high, we've created a lower low down here. Okay, now let's pretend the 50% was down here just so that we've got a decent example. Okay, now even though we're bearish on this time frame, we know that overall we are bullish, but we're not bullish until we get, roughly down here. Okay, and so by you having this perspective, you're going to get caught out less because you're not going to be like, right, where am I? Like, am I buying here? Like, where am I in the range? Like, am I just going to think that this, trend down is going to last forever, or do I have some other perspective that's going to help me change and alter that decision? Okay, these are going to be very important factors. Now, I'm going to leave this video kind of here really for this for the skill level that you're at right now. And so basically I just advise doing 2 time frames. And I know I said 3 for the rest of the course, and that's fine, but I'm specifically talking about for reading structure here. So for example, if your overall time frames are 3 time frames, you've got the 4 hour, the 1 hour, and the 5 minute. Okay, then I would advise just using your middle time frame as your higher time frame if you're reading structure, this specific method of structure. Okay, you can use the 4 hour as your structured time frame. It's up to you. The only reason I'm suggesting to constrict your time frames to potentially using 2 time frames with this method is because if you do more than 2 time frames when you're just learning this concept, sometimes it can be a little bit confusing. Okay, and so you could identify your phases on, you can still have a middle time frame if you would like, but the simplest way to do it would be, something like 1 hour and 5 minute, for example. Then just mark your phases on the 1 hour and the 5 minute, or one or both. Okay, again, I'm trying to make this simple for you, and I'm trying not to kind of, backtrack on what I've said previously, because ultimately it's going to depend how you want to read bias. If this is something that really appeals to you, you don't like having indicators on your chart, you like staying recent to price, this is a very clean way, sorry about the dogs, this is a very clean way to get involved with the markets and actually be able to detect that bias. And so if you just want to start off, you just want to use the 1 hour, literally, like the 1 hour would be mark price range, and then the 5 minute mark shift. Okay, and that's, again, this is just for the bias. You'd also be marking out your S&D levels as normal. All of that stuff stays the same. Okay, this is just about bias. Okay, so just do something as simple as that, and then you wait for a shift, and then again, which is S&D again, supply and demand. Job done. Okay, that is how simple it can be. You can just pick one time frame and just literally work it like that. It's completely up to you. As you get more advanced, you can combine the weekly, daily, 4 hour, 1 hour, and just have a better idea of where you are. I should have an example somewhere here, I believe. Where are we? Okay, so here, for example, have I done the full thing here? No, I have not. Maybe it was GP. Okay, here we go. Right. So this is a good example just to give you a little taster of how it's sometimes possible. Okay. The monthly's bearish, the weekly's bullish, daily bearish, bearish, bullish. Okay. So if we were to just zoom out here and just show you what I've done, let's just get rid of the fib because that's a little bit. Okay. Okay. So the monthly range is from this last lower high to this last lower low. Simple. Because we made a lower low, it's bearish. Cut down to the weekly. This was the last lower high. We've broken that. And so in the weekly, we are bullish. Okay, but we're not really bullish. We're not like super strong bullish. Overall, we're bearish. And so I just have that in my mind. I'm like, right, okay, I understand that price is overall bearish on the monthly, but it's definitely possible to see more bullish action because the weekly is bullish. Okay. But I know that what I'm showing you now can be quite confusing if you're struggling with, your timeframes and whatnot. Okay. And just a lot like keeping it simple. So we can see here on the daily, we have a bearish range. Okay. We are in because this is a bullish weekly range and we have this like here, the 50% is down here. Okay. And so we are in a bearish range on the daily right here. On the 4-hour, we are also bearish. It's the same range on the daily as it is the 4-hour, and you'll find that quite a lot. Okay. But on the 1-hour, I think it was the 1-hour. No, it's 15-minute. Oh, yeah. So the 1-hour is this range right here. Okay. So this overall range here with the bigger arrow. And then the 15-minute range is this one up here. Okay. So you might be looking at this like, I didn't actually take this. This is just for illustrative purposes. But you might be thinking, God, this is like, one of them's telling me this, one of them's telling me this, one of them's telling me this. That's exactly why I said just stick to 2 when you first start. Okay. But just to give you an insight, okay, what this tells me is if I go back to my 1-hour here, I know that overall on the monthly, we are bearish. Okay. But on the weekly, we are bullish. But we're still fairly high in this weekly in order before we, could potentially go higher before overall going lower. Okay. And so what I'm waiting for at least is for price to get down to the 50 on the weekly. Once I have that information, when I'm on the 4-hour and the 1-hour, etc., and I see bearish daily ranges, for example, this 4-hour bearish daily range, okay, and then 4-hour slash daily bearish range, okay, and then we look at where we are here. Again, the fib is just a way of visualizing it. We can see that we've just bounced off the 50. Now, ideally, we'd like to see it come up into these fib ranges all the way up to the 100%. Okay. But I don't know that's going to happen yet. Okay. But because I'm anticipating that more than likely that probably will happen, I would be willing to see price come down to around the 50% of this particular range here, come up into this level before coming down all the way here. Okay. Now, I know this can sound confusing. Okay. And that's why I said just 2 timeframes. Okay. So I just wanted to show you what that could look like and what the thought process would look like if you were to do that. Okay. But again, that might not be for you at all. You might just like the simple version, and that's absolutely fine. There's nothing wrong with that whatsoever. Okay. So I hope that that's made sense. I hope that's helped you to, get a clear understanding of how you can detect bias, besides the EMA cloud. Now, the benefits of doing this, instead of the EMA cloud is, as most indicators do, the EMA cloud lags, lags quite a bit. Okay. And so, you're going to get caught on the wrong side, not necessarily more often, but it can sometimes lead you astray. Now, not always. I still use the cloud, but this is just another method that you can use, and arguably, it's my favorite if you can use it properly. So, like, I like it. I find it, as I've kind of grown as a trader, I can visualize it a lot easier and stuff like that. But if you don't find that easy at all, then maybe not for you. Okay. Now, I'm sorry if I have been stumbling over my words and, not being clear enough with this. I've tried to make it as clear as possible. It's quite difficult to articulate something that you've internalized. So if there is anything that you feel that I haven't been clear about, please post it in the group chat. Or if you'd like me to make an updated version of this video, maybe you didn't quite see how to, read the structure as I was reading it or something like that, just let me know. But in summary, you can use the line chart if it's easier. Just use recent price, stick to 2 timeframes, use that as your bias, and then look for the same thing again, the lower time frame to shift, which also coincides with your supply and demand zones. Bish, bash, bosh, you're done. Okay, so thank you for watching, guys, and I'll see you in the next video.